Okay, so let's unpack this a bit. You've probably seen the headlines, right? Markets buzzing about rate cuts. But the economy, it seems to be doing, well, something else entirely, something interesting. We've got U.S. stocks rallying, U.S. bonds rallying too. It feels paradoxical, doesn't it?
It really does. There's this feeling like something significant is brewing with interest rates.
Yeah, exactly. So what's actually going on beneath these seemingly chaotic moves?
Well, that's what's fascinating, how these apparently contradictory signals might actually be telling a single story.
A cohesive narrative out of chaos.
Pretty much. We're going to connect the dots today, look at recent data, potential policy shifts, and what it all means for global assets. Basically, try to understand the logic behind it all.
Okay, I like that framing. Turning chaos into narrative. So that's our mission then, to unpack the logic, figure out if the U.S. economy is really weakening, and maybe even peek ahead to 2026. I hear there's a surprising historical echo we might touch on.
That's the plan. We're drawing heavily from this analysis: rate cut frenzy,
Right.
Trump policy, and global asset outlook.
Great. So let's jump right into that paradox. The dual rally, U.S. bonds are rising. That usually signals, weaker jobs, rate cuts expected.
Right, the traditional view.
But then U.S. stocks are also rising, which seems like they're pricing an acceleration after the cuts. It's almost like the market's talking in two different languages. Bonds say, slow down, cut rates. Stocks scream, boom, after cuts.
Or maybe they're both betting on a similar future, just from different angles. Think about it. Both moves essentially bet against a recession. Both expect the future economy to be stronger.
Ah, okay. So they converge on no recession.
Exactly. And what's really interesting is how recent data seems to be, well, perfectly lining up to support this view.
Let's talk about that data. The employment adjustment seems huge.
It was significant, yeah. Last year's new jobs figure revised down by over 910,000. That's more than the 800,000 initially predicted.
Wow. Okay, but the sources say this isn't being seen as, disorderly unemployment.
Yeah, correct. That's the crucial insight. It's a recalibration, not a crisis signal. So it effectively clears the path for the Fed to make what they're calling preventative rate cuts.
Preventative, meaning they cut before things get bad, not because they are bad.
Precisely. It lets them act without spooking the market about the job situation collapsing.
So this revision makes a 25 basis point cut seem more likely, maybe less chance of a sudden bigger 50-point cut.
That seems to be the read. It provides the data support for a, let's say, dovish shift. It allows the Fed to lean towards the employment side of their mandate.
It almost feels like the data arrived at just the right moment.
Doesn't it? It
Yeah.
certainly facilitates a smoother path towards easing policy.
And it's not just jobs, right? Inflation is key, too. What about the August core CPI? That came in kind of high, no?
It did, 0.35% month over month. If that kept up all year, you're looking at 4.3% annual inflation, still well above the Fed's target.
So how does that fit the rate cut narrative, especially with tariffs in the mix?
Well, this is where you have to look inside the numbers. The composition is key. Core goods, the stuff most likely hit by tariffs, saw only a tiny increase, 0.2% to 0.3% month on month.
Okay, so tariffs aren't causing some huge price surge there.
Doesn't look like it. But core services jumped more, from 0.2% to 0.4%, and that was mainly driven by owner's equivalent rent, housing costs.
OER. That's always sticky.
Exactly. So the takeaway is this inflation seems more endogenous internal stuff like housing rather than exogenous, like a direct tariff shock.
That's a really important distinction for the Fed, I imagine.
Absolutely vital. For policymakers, it builds this perfect logical chain. They can argue tariff inflation risk is low, maybe temporary, a one-off thing. And with internal inflation plus slowing job growth, the risk of a wage price spiral wages chasing prices up and up looks much lower.
To put it all together, and a preemptive rate cut focusing on jobs starts to look, well, pretty reasonable, like they're aiming for that perfect economic landing.
That's the narrative the analysis points towards, a completely reasonable decision given this specific data interpretation.
It's almost too neat, though, right? Like the Fed is being precision-fed the data it needs.
Well, that raises the big question, doesn't it? How much is the data leading the policy versus how much is it confirming a path they already wanted to take?
A classic chicken and egg.
It's that dance between the indicators and maybe policymaker conviction. And the narrative certainly suggests a very deliberate strategy here.
Okay, so the stage seems set for cuts, aiming for this perfect landing. But here's the twist our source didn't throw in. Is the U.S. economy actually weak? Forget the job revisions for a second. What about other signs?
Yeah, not so fast is the message there. Other indicators look pretty robust, actually.
Like fiscal stimulus, is that drying up?
Not really. The federal deficit for 2025 up to August is a bit lower than last year, sure. And the Q2 deficit rate, if you exclude interest payments, is down slightly year over year, 3.1% versus 3.6%. But that 3.1% is still high compared to before the pandemic. So the government is still providing significant support to the economy. It hasn't really pulled back much.
Okay, so fiscal support is still there. What else?
The household wealth effect? This is incredibly strong. Household net worth?
Yeah.
New highs, mostly thanks to rising stocks.
Right. People feel richer.
And crucially, disposable income compared to what people need for debt payments. Also at an all-time high. Household leverage keeps falling.
Wow. So consumers are actually in pretty good shape financially.
Very much so. The strong wealth effect boosts confidence, encourages spending, and spending is, the main engine of U.S. domestic demand.
Okay, so even with those job number tweaks, the underlying picture, especially for consumers, seems pretty solid.
That's the idea. You've got steady consumer demand plus business investment, especially with all the AI buzz.
So looking ahead to 2026, are we talking about a mix of loose money and active fiscal policy, kind of a supercharged environment?
Precisely. That interplay, strong households, government support, new tech drivers like AI, it paints a picture that's far from weak. And this resilience is key to how these potential rate cuts are seen globally.
How so?
Well, this combination, especially rate cuts before inflation is totally squashed, plus a potentially weaker dollar as a result that's generally seen as positive for global assets, it changes the dynamics for international investors.
Right. So, resilient U.S. economy, planned rate cuts. But this brings us back to that nagging question. If the economy is actually doing okay, and you cut rates before inflation is truly dead, won't that just backfire eventually?
That is the central, provocative question the analysis raises. Aren't you just kicking the can down the road, setting up future problems?
So what's the answer? Will it backfire?
The analysis suggests, maybe not in the short term, specifically the risk might be lower in 2026.
Why 2026?
Because it's a midterm election year for the Republican Party, assuming they win the White House. And the source floats the idea. Given potential White House pressure on the Fed, it doesn't rule out using actual price control policies.
Whoa. Price controls. Seriously. To make 2026 look like a best year economically for the midterms.
It's a bold suggestion, I know, but the analysis points to areas where you can already see hints of this, or where it's being discussed. Parallels to historical tactics.
Like what? Where are these potential price control efforts?
Well, look at energy. Efforts to end the Ukraine conflict quickly, boost U.S. domestic oil and gas drilling, that pushes prices down.
Right.
Healthcare, initiatives to cut U.S. drug prices down to match the lowest prices paid by other developed nations, the most favored nation idea.
Right, I've heard talk about that.
Housing, officials are apparently looking at declaring a national housing emergency to tackle affordability. What that means in practice, we don't know, but it signals intent.
Housing is definitely a hot topic.
And utilities. There was a campaign promise mentioned having U.S. electricity prices within a year. Think about the huge energy demand from AI. Controlling electricity costs would be massive.
Strong influence over the Fed, plus these kinds of price interventions. What does that remind you of?
This is where the analysis draws that historical parallel. It strongly resembles the Nixon era.
Nixon. But wasn't that about runaway inflation?
Well, yes, eventually. But the parallel is to the first half of the Nixon story. Remember, in the early 70s, Nixon used wage and price controls, a kind of visible combination iron fist, to engineer a period of economic prosperity before things spiraled later.
So the market might be focusing on that initial prosperous economy phase engineered by policy.
That's the argument, that the market sees potential for a managed economic boom driven by policy and isn't looking too hard yet at potential long-term consequences.
So this could create a sort of policy market where you invest based on who the White House favors.
Potentially, yes. Industries that get the policy tailwinds could see outsized investment opportunities, while sectors facing price controls might struggle to keep up. Even if the overall economy looks good, their margins get squeezed.
And would they risk major disruptions like more tariffs if the goal is a smooth run into the 2026 midterms?
The analysis suggests probably not. Given that overarching goal, preserving strength for the midterms, major negative policy shocks or pitfalls seem less likely. The focus would be on maintaining that positive feeling.
Okay, that's the bigger picture stretching out to 2026. Let's pull back to the here and now. What about short-term opportunities? September specifically. You mentioned liquidity.
Right. There's a small temporary factor at play. The Treasury is rebuilding its cash balance, the TGA. They slowed it down a bit, hit about $667.5 billion by September 10th, but they still need to get to $850 billion by the end of the month.
Meaning they're still pulling through.
It's a continued, though temporary, absorption of market liquidity.
Which sounds like a headwind.
It can be, but the flip side for you as an investor is that this can create opportunities. It might mean some quality, not overpriced companies get overlooked temporarily. Good companies whose stock price dips a bit just due to these broader liquidity flows.
So a chance to find value if you're selective.
Potentially, yes.
Yeah.
Strategic picking amidst the churn.
And based on this whole picture, the rate cut outlook, the policy focus, where does the analysis suggest looking for investments now?
It highlights three main areas. First, as we discussed, industries likely encouraged by potential Trump policies, aligning with those strategic goals.
Okay, makes sense.
Second, small cap stocks. They tend to be more sensitive to interest rates, more leveraged, so rate cuts give them more elasticity, more room to run potentially.
Right, they benefit more from cheaper borrowing.
And third, non-U.S. emerging market assets. Why? Because rate cuts often weaken the U.S. dollar. That makes emerging markets relatively more attractive. The source specifically mentions Hong Kong stocks could be beneficiaries here as global money looks for growth outside the U.S.
That's interesting. So how does this all look in practice? Do we have an example of translating these macro ideas into an actual strategy?
We do. The sources use a virtual portfolio example called the Alpha Dolphin, which really illustrates these themes.
Okay, tell me about Alpha Dolphin. How's it doing?
Well, just last week, it gained 2.2%. That actually outperformed the S&P 500, which is up 1.6%, and the CSI 300 in China up 1.4%.
Better than the U.S. and mainland China benchmarks.
Nice. It did lag MSCI China overall, which was up 4.2%, and especially the Hang Seng Tech Index, which jumped 5.3%. But the performance shows how these forces played out.
And what about longer term? Does it show these themes working over time?
Oh, absolutely. Its track record is pretty impressive. Since it started back in March 2022, it's up 109% in absolute terms and generated an 89% excess return compared to the MSCI China Index.
Yeah.
So a hypothetical $100 million invested would be worth over $211 million now.
Wow. It's quite a performance. What drove the recent gains?
Mainly Chinese concept stocks, names like NetEase, Alibaba, Bilibili. They benefited directly from those rising expectations of U.S. rate cuts.
And why did it lag the really high-flying tech indices sometimes?
Because it also holds a good chunk in defensive assets, gold, U.S. bonds, U.S. dollar cash. About 45% is defensive, 55% equity. So while that provides balance and cushions downturns, it means it won't capture all the upside when volatile indices surge. It reflects a more balanced approach.
Yeah, that 55.45 split shows a clear strategy, balancing the growth potential, especially in non-U.S. assets, with some risk protection.
Exactly. It's a practical example of navigating this complex environment we've been discussing.
Wow, okay. What a journey today. We've gone from decoding those mixed signals in the market through the nuances of job data and inflation, all the way to this potential Nixon-esque playbook for 2026.
It really connects the dots in a powerful way, doesn't it, behind the headlines?
It does. It feels like getting a peek behind the economic curtain. And hopefully understanding these connections helps you navigate what often feel like contradictory signals out there, make more informed decisions.
Definitely. And it leaves us with a really important final thought, I think. In a world where economic policy might, just might, become more closely tied to election cycles, maybe even using overt price controls, how do you adapt? How do you, in your own thinking and planning, learn to tell the difference between genuine economic strength and, well, potentially strategically manufactured best years?
That's a heavy question to leave folks with. Differentiating fundamentals from managed perceptions.
Something to definitely ponder.